I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZB. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman. He's the derivatives portfolio manager at PI Financial in Vancouver. His websites, pifinancial.com and polarfuturesgroup.com. Welcome back to the show, Drew.
Thanks for having me on, Jim, and Happy New Year to you, even though it's a little late.
Drew, running a managed futures program last year being so volatile, how did you get through 2018?
Yeah, last year was definitely volatile. I mean, we had the volatility spike at the start of the year that really caused a market sell-off, and then things regrouped all the way into the end of August into the beginning of October, not end of August, where equities really rolled over again. We had crude oil collapse as well, going from $76 down to the $42 handle. But I was fortunate enough to manage my risk and take a few opportunities that I saw in the market and managed a 11% return. And that is a net of fees for my managed program. So that's your all in your account at the end of the year number, which I was very happy with. Had some opportunities to do a little better that we missed, but at the same time, managed to cover ourselves on a few riskier positions before they got out of hand. So was happy with the whole year, especially given the volatility that we saw and the fact that, the overall equity markets were very volatile in the final quarter and down a little over 6% on the U.S. equity markets and even more here in Canada. So happy with the results.
What sectors worked out the best?
In my managed program, I do a lot of trading. I trade in the futures and options space. So I do a lot of the financials. That's the debt instruments. So I had some good trades in the bond market, U.S. bonds, that is. Also had some good trades in the currency space, being long the U.S. dollar, being short of the Canadian dollar, the New Zealand dollar. And I managed to catch part of the drop-off of crude oil in the end of the year as well. So a good mix throughout different sectors, and that's what I'll always look for is just opportunities as they come in each sector, given my general macro thesis. So a mix, not a certain sector that really outperformed for me.
Taking a look at currencies just for the moment, I thought with the Brexit vote being turned down in British Parliament by such a large majority that the British pound would take a hammering, yet it's just down a tiny fraction along with the euro. Was that a surprise?
Yeah, I mean, the British pound yesterday sold off dramatically, to say the least, and then recovered dramatically. So a serious amount of volatility, and then we went into the confidence vote that we had here today and passed that, although narrowly. I think it was about 20 votes that passed, and the British pound is marginally up on the day after ending yesterday flat. So I think a lot of people got worried about what was going to happen as we went into the vote. Again, the biggest surprises in markets come when we get something that we're not expecting. And I think the vote both yesterday and today was right in line with what the market was expecting. Now, does that mean we know what's going to happen going forward? No, I think that's still, a very confusing topic. It depends on, what the group in Brussels, what the EU is going to do. But as of right now, May is still in control to some degree, maybe loosely, to put it that way. And I think the market is saying, okay, if we don't have to have a hard Brexit and headlines are coming out that maybe we get to shift this down the road again. And of course, as politicians, they love to kick the can down the road. Why deal with a problem today when you can deal with it 6 months from now? Seems to be a very common theme. So if we can push it out of sight, out of mind, then, we see, things just kind of muddle along. And if that's a better scenario than, worst case scenario that could have happened, that's where we see the British pound sort of just getting back to where we were. It wasn't the worst case scenario that maybe was feared could have come that would have taken the British pound a lot lower.
Of course, too, the deadline is March. They could just say, well, I guess we won't have a negotiated Brexit. We're just out.
Yeah, that's one of the many options. The one business that is probably booming is the betting sites throughout England. They've got odds on all of these different events and what is likely to happen, and they're very busy. So whether it's a hard Brexit, they're just out, whether we delay it, whether they will actually go back and renegotiate, although that seems unlikely. It is all up in the air, and I think that's where going forward, we're likely to see continued volatility until we get a little bit of a firmer idea of what's going to happen. But the EU doesn't want to see a hard Brexit any more than the British businesses do or British people do. It's not good for anybody. I think that's hopefully should be the last case scenario. So we'll see if they're able to come to some compromise. And my most likely thought is that the compromise will be, kicking the can down the road and, hey, let's have some more time to figure this out because we don't want the worst case scenario to happen.
We'll have more with Drew Zimmerman right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI, and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, U.S. stocks are up roughly 4.5% for the Standard & Poor's so far this year after falling over 6% last year. Do you think stocks will continue to move higher?
Yeah, stocks have had a tremendous bounce out of what's being called the Christmas massacre. So where we posted a low on Boxing Day, the day after Christmas, and then have rallied sharply and almost uninterrupted since then. I think they're up about 13% from that low. So a very sharp move. I get the sense that maybe we're running out of steam on this sort of sharp bounce. A lot of the bigger economists out there are looking at the data and saying data is still soft. If we're going to be in a bear market, you do get these periods of severe rallies, and that is because as people get short a market, they want to get short in more size as it starts to go down, and they may even panic and add extra contracts just to try and catch up to hedge their overall portfolio, and that exacerbates the selling. However, if they start going back up, if stocks start going back up again, you want to uncover yourself and then expose yourself to the upside again as quickly as possible, which also exacerbates the move to the upside. So it had been, some very big moves initially in the S&P, and now over the last week or so, they've really quieted down. And, we went from having, 50 to 100 point intraday moves in the S&P Now, over the last week or so, we seem to have quieted down to a more regular sort of 20-point, 30-point range, which is quite a bit smaller than we saw at the end of last year and through the very start of this year. So that shows me that maybe some of this momentum is starting to wear off. We're also running into some technical resistance on the Dow and the S&P. The Nasdaq has been even stronger with some of those big momentum names coming back even firmer. I've been looking at it to see signs that it might be running out of steam. To look at the short side again, I think you look at what's been going on with the U.S. data and the data that we are getting, and we're not getting some of the data because of the government shutdown in the U.S., but that data is slowing. The data that we're getting out of Europe is slowing. The data that we're getting out of China is definitely slowing. But at the same time, and especially over the last week or so, we've gotten sort of continued easing measures out of China that is, maybe putting a bid back into the risk market, back into equities. So if global central banks through the end of 2018 had been pulling back their stimulus, the ECB finished their new bond purchases at the end of last year. The Fed is tightening rates as well as winding down their balance sheet at $50 billion a month. So that was taking this stimulus out of the market. And now in the last little while, we've seen some of that stimulus sort of jump back into the market. And the Fed hasn't turned around any of their tightening. However, they've definitely come out strongly to say, we can pause doing any further rate hikes, and we can look at what we're doing with the quantitative tightening and reverse it if we need to. So sort of we used to have the Bernanke put or the Greenspan put even before that, and then the Yellen, and now everybody's saying, where is the Powell put? And it seemed to be lower than his predecessors. However, it still seems to be there, and the central banks sort of came to the rescue of the equity market. So, I think this bounce may be overdone on that safety from central bankers. But again, I'm going to try and wait and see if we run into some firmer resistance or even start to turn lower before I try and act on that.
If the Fed is going to pause like it seems it will, does that mean that rates are no longer going higher and may even come down?
Yeah, I mean, we had a dramatic correction in rates as everybody had gotten short of the bond market in the United States. So that was getting short of bonds to see rates move higher, and that was a great trade. It worked out really well. U.S. 10-year rates hit 3.25%. And then they turned lower as this equity volatility came into the marketplace. I thought we'd see rates maybe pull back to 2.8% or so in the 10-year. They dropped more dramatically all the way to 2.55%. But now as the equity markets have really bounced back, rates have come back a little. I mean, you've got the U.S. 10-year, 2.7%, a little better than that. But, not as severe a bounce back or not as much of a bounce back as we've seen in the equity markets. So I think rates are still going to go higher. I think that's a function of the amount of debt that the U.S. has. I think even if equity markets are going to go lower, maybe in a more orderly fashion or even just sort of muddle through here, I think that does bring us higher rates. But we're not going to see the rate of change in rates like we saw through the middle part of 2018 where they jumped dramatically higher. I think that the Fed having, put themselves on the sidelines near term sort of takes away the near term risk of a steep surge to new highs in interest rates. And also the inflation outlook that we have, especially with the oil market coming off, takes away some of that risk of the surge to new highs in rates. So I'm looking for rates to continue to drift higher, especially if stocks sort of muddle through near term and get into a consolidation range. But at the same time, I'm not looking for a dramatic increase in rates to new highs.
We'll have more with Drew Zimmerman right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, oil prices have also bounced back strongly from the Christmas lows. Do you see oil prices trading higher?
Yeah, as with equities, the risk-on theme came right back into the oil market as well. We traded down to the 42 handle in crude oil. We've traded back up over $10 from that low level on crude prices, so a significant bounce. And a lot of what was happening with crude was, I think at the beginning of October when we were at $76, the market was looking for global demand to continue to be strong. And I think that was the bigger side of the crude market that really caused the price slide. So we've had OPEC come out and announce supply cuts. That's production cuts. We've had Alberta announce production cuts. So some of the supply coming off the global market. However, the bigger worry was that global demand just wasn't going to meet that supply and we were still going to be oversupplied. And I think that bounce that we've seen off the lows was a reaction to the supply cuts. But when you look at the internals, and I don't want to go too far into the oil market, you've got in the forward curve a contango market that we have right now. So that used to be in backwardation. That meant the front months of the oil contracts that we trade were demanded more than back months. So that was firm demand. We now have the front months trading at a contango or a discount to back months. So that's telling me that there still isn't demand for oil right now, and it's been more of a supply side issue that's caused prices to come back up, or the supply cuts that we've seen have caused prices to come back up, but still haven't seen that strong demand. I'd want to see that to get more bullish over a medium to long term on crude oil. So I'm looking for possibly a consolidation range in oil as well, but still not all that confident that this $50 level that we've broken back above will hold. And if we were to see another weakening in the stock market, or again, just that general sentiment of global growth slowing, then I think we see crude oil really struggle again, because it's been more of trying to fix the supply side, cut back supply, rather than seeing firm demand. And if that demand gets hit even further, then our supply demand is out of whack, and again, prices go lower. So I'm hoping that we can hold this consolidation range and stay above $50, $49. But I think if equities roll over and market sentiment takes a hit, that we're likely to see lower crude prices and possibly retest the low that we had at Christmas.
True, the Canadian dollar had a very sharp rally to start off the year. Why was it so sharp, and what was behind it?
Yeah, the Canadian dollar stayed lower even after equity markets started to rally back. It was down right into the end of the year. And then we had, really 3 very sharp days where Canada rallied from 73.5 cents to 75.5 cents, and then it carried on a little higher towards 76 cents after that. But a lot of that was U.S. dollar-based weakness as much as Canadian dollar strength. So the big move to me was when we had Powell at the Economic Forum with Yellen and Bernanke on stage, and he really did his 180 there. He went from raising rates on December 19th in the U.S. and saying that, the economy was good and strong, and that the Fed pull back the quantitative tightening of $50 billion, the runoff of the balance sheet, was on autopilot. That was a very hawkish statement. So when he turned that around at the start of this year and said, we can look at that autopilot statement. We will make changes if we need to, and we're likely to be on the sidelines for interest rate hikes to see what's going to progress going forward, and we can always change our policy stance very quickly. We also, going into this year, have a press conference at every single interest rate announcement. So we've got another one at the end of this month. So every announcement now, he's got more ability to sort of fine-tune his message rather than just the brief statement that we come out. He can do the Q&A to try and direct the market to where he's thinking. So that was a very sharp turn in the U.S. dollar. The Canadian dollar had been, very oversold. It had been, almost going straight down ever since we got a pop higher on the NAFTA agreement that happened at the beginning of October. So that was when Canada popped above 78 cents on the USMCA getting signed. And then Canada started to turn lower. That was sort of everything good got priced into that, I think. And then also important for Canada was the fact that we had crude oil prices. We had crude oil prices go from $76 down to $42. And we had, through a lot of that, the Western Canada Select, that's Canada's crude oil prices, at up to a $50 discount of WTI prices. So there was a lot of headwinds going against Canada that probably pushed it down to be oversold. And then when the U.S. dollar turned and crude oil was rallying and equities were rallying, Canada just got a very aggressive pop over a short couple of days.
Well, also Alberta has threatened to cut production of Western Canada Select oil. So that saw a dramatic increase in the price. And now the gap between the world price for oil and the Western Canadian Select is only $7 or $8. That must have helped the Canadian dollar.
It has definitely helped. I think there's, the easy way to look at it is to say, hey, that discount has narrowed. That is a great thing for Canada. We're getting more for our oil price. And that's true. However, we are producing 350,000 barrels less every day. So you have that, sum of cash that you just have to take out of the equation. And going forward, I also worry about the fact that that discount is how you incentivize or how you pay people to take crude out of Alberta or out of Canada. So if you've taken that discount away from them, because we're at a discount now that it actually costs that much money to send oil through a pipeline. So you can't make money if you're a company who's willing to take risk, buy oil, put it on a train in rail cars, ship it down somewhere, and sell it there, and you make the differential or that spread. So they're not getting paid anymore. So we've disincentivized companies or people to find ways to get oil out of Alberta. And I think that is maybe a blunder that we're not seeing the effects of immediately. We see the immediate effects of the oil we are producing is getting a higher price, which is a good thing. But going forward, I think we're still in a big predicament in Alberta that, we're not creating enough export capacity. And, this is just going to exacerbate that problem in my mind.
Well, a survey of Canadians found that the majority of them, I think 58% feel the lack of pipelines is a national crisis. And in Alberta, that number was over 80%. Will that spur the government into more action?
It may, especially as we come into election time. I don't have high hopes that spurring the government into more action creates any immediate benefit for sure. I mean, we can look at the pipeline the federal government has just bought. I mean, we're not moving any faster on that front than we were previously. So I think there needs to be a general rethink of the way that we're looking at the issue. I agree that, it needs to be deemed as a Canada-wide issue. I think it's easy for a lot of people to, just point the finger and say, that's a problem they have in Alberta. It doesn't affect me here. And that's really just not the case. So I hope we can come together as a country and realize what we need to accomplish, what economic meaning that has for all Canadians going forward. And I hope we're able to do that. And it's good that in those polls we're starting to see that sentiment move in that direction.
Drew, thank you so much for chatting with us.
Thanks for having me on today, Jim.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's pifinancial.com and polarfuturesgroup.com. If you have any questions for Drew or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.